Okay, good afternoon, ladies and gentlemen. Welcome back to this weekly market review. Today, I have with me Mr. Gerald Wong again, and the market seems to be not doing very well. How are you feeling, Gerald?
Yeah, so I think there has been more uncertainty in the market over the past few weeks. We have seen an increase in geopolitical tension. We have seen US government bond yields continuing to go up. So those have actually affected the market sentiment very significantly.
Yes, I think we have the Middle East crisis that's very worrying. It's still intensifying, and today is a Hong Kong holiday. It's Chongyang I'm not very sure what is that celebration about. And we also have the US Treasury yields go up to 5% on the 10 years. So will you be breaking that down for us, Gerald?
Yep. So quite a number of things that are happening over the past week. What we see and how we observe the market going forward will definitely be something that we will share with the viewers today. But before we start, we will have a quick disclaimer that today's sharing is for education purposes only. It should not be taken to be financial advice in any way. If you find the session helpful, do leave us a review on Google, either by scanning the QR code or by going to the link that is shown here. And last but not least, if you have more questions after today's session, do consider joining SIAS as a member. Then you can actually participate in more events such as the Ask SIAS webinar. And the membership for SIAS only costs $1 per month or $12 per year. Okay, so we'll dive into the markets, and what we see here is that it was a very red week for the market where major indices actually fell across the board. So in the US, we saw that the S&P 500 declined by 2.4%. And in Singapore, we also saw fairly significant declines with the STI down by 3.4%. Quite a number of factors that is driving this sell-off in the market, and we'll see what are some of these factors individually. Okay, so this is something that has been going up over the past few weeks, and it is the US 10-year government bond yield. Effectively, what we see here is that it actually touched a very important point of 5% sometime last week. And from an investor perspective, that is effectively a psychologically important point. Because if you think about being able to get a risk-free return at 5%, that effectively makes a lot of riskier assets less attractive compared to the US government bond. Okay, so we have seen this gradual increase since August of this year. And effectively, because the Fed has signaled that interest rates are going to be staying higher for longer, inflation remains elevated, and then at the same time, the US economic data continues to be very strong. We have seen that the government bond yield in the US has actually moved up consistently, such that it actually hit the 5% mark. Okay, so this is something that we'll look out very closely for. Yes, retreated a bit after hitting the 5% mark, but if we see that it actually stays above 5% on a more consistent basis, then what this means is that investors may reevaluate their allocation towards riskier assets, where they have to effectively taking on more risk to be able to generate the return versus effectively risk-free asset such as the US government bond. Okay, so that is something we'll continue to keep a very close lookout for. Next, we still have the Middle East conflict that is intensifying, and that has got repercussions across various asset classes. One of the key areas where we see this having an impact is in the oil price. Okay, so we have seen a lot of volatility in oil price over the past few weeks. Initially, we saw this spike in September because of the fact that Russia and Saudi Arabia extended their production cuts through the end of this year. So initially, it was very driven by concerns about supply being slower than the growth in demand. Then thereafter, as the 10-year government bond yield moved up, we saw that the oil price came down because the thinking is that with the 10-year government bond yield at high elevated levels, there are increasing risks of a recession, and that actually might lead to weaker demand for oil. So we actually see oil price coming down all the way down to about $84 per barrel. But because of the escalation in the Middle East conflict, we see that effectively it has gone up to above $90 per barrel once again. Okay, so another key metric to be looking out for in terms of where oil prices are heading towards, because that may affect quite a number of other things, including, say, inflation and how different asset classes actually react. Okay, so overall, what we have observed is that there is a spike in market volatility. We can effectively look at this using the VIX index, which is something that allows us to keep track of how investors are pricing in the market volatility. And what we see here is that the VIX is now at above 20. The last time it was actually at this level was actually closer to March this year, where, if you recall, because of the collapse of Silicon Valley Bank and concerns around the US banking sector, we also saw a very sharp spike in terms of the market volatility. Okay, so all in, there is more uncertainty in the market, quite a number of different moving parts that we need to be keeping a lookout for in terms of whether there's an escalation in the Middle East conflict, whether we see the US 10-year government bond yields continuing to move up. And those are the things that investors will have to bear in mind as they navigate the market through the rest of this year. Okay, so how has that translated to the performance of the Singapore market? First and foremost, when I was doing this chart for the STI top performers in the past week, for those of you who have been following us closely, in the past it was STI top gainers. I have to change it to top performers when updating this presentation deck, because there wasn't a STI stock that had positive gains in the past week. Okay, so the top performer was Imperador, that was flat over the last week. But even for some of the stocks like Genting Singapore, Hong Kong Land, OCBC, and Thai Bev, that actually had some slight declines, they were already doing than the benchmark STI index. So what we see here would be a number of different stocks. Genting Singapore having a bit of an uplift after Las Vegas Sands actually reported their earnings, and we saw that MBS continued to do well. Okay, apart from this, we see that quite a number of stocks that are continuing to be a bit more resilient. Maybe some of the names exposed to consumer staples, the alcohol-related stocks, because they might be deemed to be more resilient, even there's going to be a sharp economic slowdown. But if you were to look at the top losers, there are quite a number of names here that had fairly sharp declines in the past week. We've got SIA down by 7.3%, Jardine Matheson down by 7.5%, CapitaLand Ascendas REIT 7.8%, UL 8.8%, and Yang Zhejiang Shipbuilding down by 12%. So quite a number of cyclical stocks in here. I guess for SIA, the concern is around how the higher oil prices will affect its profit. And you also have a few names here, say UL, where the concern might be how higher interest rates will affect the need for buying new homes, given that the interest rates are at more elevated levels. We are also starting with the earnings season. So we saw quite a number of stocks starting to report in the past week. Firstly, we've got the Keppel-related companies, including Keppel Corp, Keppel DC REIT, Keppel REIT, as well as Keppel Pacific Oak, US REIT. So what we see here is that in terms of the earnings, Keppel Corp actually saw higher net profit in the first 9 months of 2023 compared to the previous year. But the REITs actually performed worse compared to the previous year, because if it's to look across the board, the distributions actually came off, mainly as a result of higher financing costs. So once again, we are starting to see the repercussions of the higher interest rates and how they are impacting the income as well as distributions of different companies. Okay, so we'll start by looking at Keppel Corp. effectively what we see here is that it started to come off after hitting close to about 750 sometime in August this year, and now about $6.30. Okay. What did we see for the results that it reported? We saw that the revenue in the 9 months of 2023 was about 5% higher to the comparable period last year. If we were to break down across the different divisions, then where we see the revenue growth will be in the infrastructure division, as well as the connectivity division. But where it was actually weaker is actually in the real estate segment, where the revenue actually came down compared to the previous year. Okay, so once again, we are starting to see how the higher interest rate environment is starting to affect some of the more interest rate sensitive sectors, such as the real estate sector, and that is reflected in the lower revenue that Keppel saw within the real estate segment in the 9 months of 2023. But what was positive is really in terms of the distributions that Keppel Corp has been announcing throughout this year. So if you recall earlier this year in March, we saw the distribution of Sembcorp Marine shares, which is now renamed as Seatrium. Okay, so that came through after the combination of Sembcorp Marine and Keppel Offshore and Marine. We also saw a final cash dividend of 18 cents per share in May this year. And then we saw the first half interim cash dividends of 15 cents in August, and also the distribution of Keppel REIT units. So in total, as a Keppel shareholder, you will effectively have received cash distributions and distributions in specie amounting to close to $2.70 per share so far this year. And if you're to add just the cash dividends, which is the final cash dividend of 18 cents, the interim cash dividends of 15 cents, that would amount to about 23 cents per share. And based on the closing price of $6.32, representing a dividend yield of 5.22%. Okay, so this is what we see for Keppel's dividends. There was a decline in 2019 and 2020 because of the challenges faced within the offshore and marine division back then. But it has actually returned up to 33 cents in 2021 and 2022, and the strong dividend payout has continued into 2023. Okay, so that is Keppel Corp, where we saw the company announcing the third quarter operational update last week. Okay, next we have Keppel DC REIT, and what we saw here is the very sharp decline in the share price over the past week as a result of the operational update. Okay, so what did we see in terms of the distributions? It was actually down compared to the previous year. If you look at the distributable income, it was at about 44 million in the third quarter, compared to 47 million in the third quarter of 2022. So that is translating to lower distribution per unit, and that is one of the reasons that is driving the sell-off in Keppel DC REIT. Okay, so what is driving this decline in distributions? Because actually, if you were to look at the gross revenue of Keppel DC REIT, they were still able to grow it in the third quarter of 2023. So the occupancy rate as well as the rental income that they are able to generate still continues to be fairly resilient. But what is actually driving the decline in distributions is this very sharp spike in finance costs, which went up from 8 million in third quarter of last year to about 13 million in the third quarter of this year. Okay, so that's close to a 57% year-on-year increase, and leading to a lower distributable income as well as distribution per unit. So once again, we are starting to see the higher interest rate starting to impact the REITs, and it is reflected very tangibly here if we were to look at the finance costs incurred by Keppel DC REIT. Okay, this is effectively the dividends of Keppel DC REIT. if you look at where it has traded since 2017, it has effectively been able to raise it on a year-on-year basis. So once again, that is one of the reasons why we saw the sell-off in Keppel DC REIT, because of the fact that we are starting to see distributions actually coming down compared to the previous year, when actually if you're to look at the trend over the last 5 years, they have been able to consistently raise the dividends. And I think the decline that we are now seeing is driving concerns by investors. Okay, if I were to look at Keppel DC REIT's dividend yield now, it is at about 5.8%. This is based on the consensus forecast. And if I were to compare that to the historical average, that is effectively close to where it was at the high sometime last year as well. So that is something that investors can keep a lookout for in terms of the dividend yield, and weigh that across other instruments that can potentially give a good interest rate as well, whether is it a Singapore saving bond or other kinds of asset, and decide whether it is worthwhile to take the additional risk by looking at a REIT with data center assets like Keppel DC REIT, or whether they might prefer something with relatively lower risk, such as the Singapore savings bond. Okay, last but not least, we've got Keppel Pacific Oak US REIT. Again, we've seen the share price of this US office REIT coming off very sharply since the start of this year, and now leveling at about 21 cents. So if we were to look at the earnings for Keppel Pacific Oak US REIT, so we see that the gross revenue and net property income continues to be once again fairly resilient. So despite all the concerns about weakness in the US office market, higher vacancies, actually they were still able to keep the gross revenue and net property income at a level that is slightly higher than where it was at the same time last year. Okay. But once again, what we see is that the income available for distribution is down compared to the previous year by about 11%. And that is once again because of the higher interest rates. Okay, so if you are looking out for dividend yield, you have seen this chart for Keppel Pacific US REIT, where it is now offering a dividend yield of about 23%. This is based on consensus forecast. And if it is able to really pay out such a high dividend, then that is the potential dividend yield that investors might be able to get. But once again, what we saw is that the distributions actually came down compared to the previous year. So I think what a lot of investors are doing is to discount this 23% dividend yield by thinking about how much it could potentially decline further if the interest costs continue to go up and continue to affect its distributions. Okay, so we have started to see some Singapore companies reporting. We'll go into full swing for the result season this week, where you see more REITs actually reporting their results, including Mapletree Pan Asia Commercial Trust, CapitaLand Integrated Commercial Trust, as well as Mapletree Logistics Trust. Okay. On top of that, we are also starting to see some of the banks reporting. UOB is reporting this Thursday, 26th of October. And that is once again something that investors will look out very closely for, to see whether banks are able to continue their strong profit track record, like what we have seen in the past few quarters. On top of that, like Sunny mentioned at the start of today's session, the US tech stocks are also going to start reporting this week. So that is going to be, once again, very closely watched. And on top of that, we have got all the macro indicators coming in. So for investors, that is something that's going to be keeping us very busy for the rest of this week. So with that, I'll pass over to Sunny, who will share with us how we can think about all of these movements from a technical analysis perspective.
Okay, Thanks, Gerald, for helping us read the tea leaves of the market. And so you can see that the SIAS index today on the 23rd of October, this morning, it has actually started on the lower side of things. It started around the 3,065 points level. However, we have rise about 10 points. We are now at 3,073 points. So we have broke some of the major support level, as you can see over here, the 3,155 and the 3,128 level. We have even broke the previous year to date low in March, somewhere at around the 3,094 points level. Today, we have a new year to date low again at 3,065. So that is a new year to date low. Market is very jittery and weak right now. And is this level a support level? I would have to look back further in history. And around this level was actually the June low that we saw last year. And that's around the level of 3,072. So the level that we are at now, 3,073, 3,074, is actually the June low of last year. So this is the support level that the market is trying to hold on to. And looking at the technical indicators, the MACD still has not shown any signs that the downside momentum that we are seeing since the peak somewhere in the 1st of August at about 3,400 levels is subsiding any soon. The downside momentum is still very strong and not showing any signs of subsiding according to the MACD indicator. The RSI has already breached the 30-point oversold mark. It is now reading at the 29 points, 1 point below the oversold trigger, oversold level of 30. And the lowest RSI level that we observed this year during the March low was around the 22 points level. So although we have hit or we have triggered the oversold level of the STI index, it's not immediately clear that we will see a rebound. We might still see a bit of a pullback like what we saw in March on the RSI level before we see a rebound. So I think this level would likely be a consolidation level or a support level to hold for STI, but I do not expect to see a big rebound very soon, but I'm thinking of going in around this level. Because if we break this level, the next support level would likely be the October low around the 2,968 points level. And that is quite a distance away unless we have more bad news coming in from the Middle East, as well as higher oil prices. And of course, the US Treasury yields getting higher again. So this week, the focus will on the global markets will likely be on the US tech stocks reporting their earnings with names like Alphabet parents, Google parents, Alphabet, Microsoft, as well as Amazon. So today, like I said earlier, is Chongyang Jie. So Hong Kong market is on holiday. So no trading on the Hang Seng Index. So by this point, I can see that the Hang Seng Index has sort of formed a mini double bottom formation. But as today is a holiday, I do not know whether this double bottom that you see between the low of 4th October and last Friday, 20th October, is going to hold. According to the MACD indicator in the Hang Seng Index, it seems like the MACD line, the black line, is going to cross over the red line, which is the signal line, and that would mean that we may see the expansion of the downside momentum towards the downside in the next few trading sessions. That is what the MACD is telling us. On the RSI at a reading of 39 last Friday, it's about 10 points below the 50-point neutral mark. So it tells us that its sentiment is very weak in the market, momentum is very weak in the market, and we have yet to trigger any of the oversold level, or we are not even close to the oversold level of the 30-point mark yet, where we see a rebound somewhere in the 21st August period, and that level is at 26 according to the RSI on 21st August. Okay, let's move to the major US indices. So first thing first, Dow Jones Index. So we can see that the last 3 or 4 trading sessions, Dow Jones Index has come down quite a bit. So the recent low that we observe will be somewhere around here. This is the 32,800 points level, and that is the low on 6th of October. Okay, so this is the first level of support that we are looking at. Below this, we also have the 25th May low, somewhere around the level of 32,586 points. So these are the 2 critical levels that we will be watching. But as you can see, the MACD indicator is also not looking very promising. The MACD histogram in the background that you see here shows that the upside or the uptrend momentum that we observed since the 4th of October low is actually subsiding. And we are looking at a crossover of the MACD lines to below the signal line, another confirmation that the downside move or the downside momentum is actually going to be expanding further. So this may accelerate and we may even hit the March low of 31,429 points. The RSI is also very weak in the reading at 35, so very far off the 50-point neutral mark, 5 points away from the 30-point level where we will trigger the oversold signal. So the October low on the RSI we observed was somewhere around the 24 points level. So I think unless the RSI come close to this 24 points level, I do not foresee a rebound soon for the Dow Jones index, and that could come somewhere around the level of at least at the 32,800 points level, which will break the 33,000 psychological level that we have for the Dow Jones index. Next, let's move to the S&P 500. S&P 500, okay, as you can see, 1, 2, 3, 4 or 5 sessions, we have a pullback already. We also have the MACD indicator confirming the crossover of the signal line, of the MACD line below the signal line. So that means that downside momentum is expected to accelerate downwards. And this resistance level may have a change in polarity over here around the 4,200 points level, may not be able to hold if the MACD signs show us that the momentum will deteriorate further. And the next support that we would probably be looking at will be this double top kind of formation somewhere in the end of 2022, and hopefully it will have a change in polarity to provide the support for the S&P 500, which we saw somewhere in May. Once it hits this level, you can see the upside that went up from the May to the July period, where the S&P 500 was up about 12%. So this will be the closely watched level. The 4,200 points level will be most likely the next support level that we'll be watching out for. Next, let's move to the tech-heavy Nasdaq Composite Index. Nasdaq Composite Index is using the 200 days moving average, which is the red line over here. This is the EMA level, exponential moving average level, at around the 12,978 points. So we closed at around 12,983 points. So it will be using this level as a support for the Nasdaq Composite Index in the short term. We also have MACD confirming the downside momentum is accelerating with the crossover of the MACD line to below the signal line. And the RSI is reading at 36, 6 points above the oversold mark of 30 points. So we are waiting for some kind of a indication that the RSI might be reversing, because we saw during the September period when RSI hit the low of 31, it starts to rebound back upwards again. And also during the August period, we see that RSI reading hit 32 and starts to go up again. So closer to the 30-point mark, right, that would be where the Nasdaq Composite will likely rebound. And some of the signs that we'll be watching out for this week, of course, will be the tech earnings that has been driving the US market bounce up, or the upsides for most part of this year. So this week will be a closely watched week, and there's a lot of things that we investors need to watch out for. So that's my coverage today on the indices. Gerald, anything to add?
Yeah, so I think you summed it up very well, that there are quite a number of different moving parts. We have got the Singapore earnings season, with the REITs being closely watched, UB starting to report as well. The US tech stocks also going to be something that investors will keep a close lookout for. And then on top of it, all the different macro developments. So if you want to stay updated around some of these developments, do tune into our weekly market review the same time next week.
Yes, so while Gerald and me were busy tracking the market for you, we would like to advise you to trade safe also, because market sentiments is really not very good right now with the VIX, the fear index, at the all-time high now, or not the all-time high, but the recent is above the 20-point mark, which is a very kind of there's a lot of fear in the market right now. So it's the difficult decision to catch a falling knife. But once you can see if there's any indication that the downside momentum is subsiding or rebounding soon, we will update you again on our weekly market review. So that's all we have for this week coverage, and we will see you again next Monday, same time, same place, same channel. Okay, goodbye everyone.
Thank you.